Trading with a full-time job is a great way to supplement your income, but you have to be smart about it. For us working professionals, we are limited by time constraints, energy, and work commitments. Therefore, to successfully trade with a full-time job, we need to leverage on technologies and tools to make trading as automated as possible. In this video, I'll be sharing my tips on trading with a full-time job. And to be honest, it is easier than you think, unless of course you're still drawing charts manually like the 1980s. It is very feasible to trade while working. In fact, trading with a full-time job could be useful because your boss might thank you for staying late while you were just watching price action. So stay tuned to the end of this video. As someone who trades while working a full-time job, I've got the tips that you need to make it work.
Welcome to Bull Compass.
Tip 1. Trade longer time frames. Trading longer time frames take the pressure off trading and allows you more flexibility to focus on your work. When you are trading longer time frames, you do not need to constantly monitor the charts throughout the day because you're not that concerned with the price movements within the day itself. And this frees up your time to do other activities. However, if you are day trading, then a lot of time will be spent monitoring the price volatility of the market within the day itself. Right now we are on the Bitcoin chart. As you can see from this small candle over here, this doesn't look very exciting. That's because we're looking at it through the day chart. Alright, on the daily time frame, this looks like a very small price movement. And there's not a lot of excitement if you just concentrate on this one candle alone. However, if you go into the 1 hour chart, you will see a sea of volatility. The 25th day chart candle actually starts forming over here and is still currently being formed as this recording is being taken. So as you can see, as a day trader, you might need to short over here, close the trade here, short here, close here, take a long maybe perhaps here, and then close it over here. So day traders, and if you're trading very short time frames, you tend to enter trades very fast and close them even quicker. And this takes up a lot of time. It is very time intensive. As you can imagine, trading shorter time frames can be very exhausting. If you want to juggle a full-time job with trading, then perhaps go for swing trading. I personally only check my trades twice a day. I manage this by allowing technology to do the work for me. You can set price alerts to warn you when certain key levels has been reached, set trading stop losses to lock in profits, and use conditional orders to automatically execute trades once certain price levels have been reached. Now this brings us to the next tip. Tip number 2. Use OCO orders. OCO is short for one cancel the other, which is a fancy way of saying either or. Think of it as telling the computer to fulfill either order 1 or order 2. Once an order has been filled, the other order will be automatically voided. This kind of order allows you to aim for trade entry during a breakout scenario or a retest of a support level without the need to be glued to the computer. In this way, an OCO order allows you to set triggers to open a trade once price hit your entry levels. Let me demonstrate how it is applied in real life. Take this pattern for example. If you estimate that price will rebound from the support trend line at 194 or that a breakout above the resistance trend line at 254 will take price higher, you can set an OCO order to accommodate for both situations. This is how I set the order on the exchange. 194 will be the limit order, while 254 will be set as the stop limit order, which means that a limit buy order at 254 will be placed automatically when price reaches the 254 level. Different exchanges have different variations on how to go about setting an OCO order, but the general idea is all the same. So it is best to read up on how an OCO order works on your exchange first before using it. This way, you can concentrate on working on your full-time job while the computer executes trades on your behalf. This tip might even keep you disciplined in trading your trade plan. How many times have our itchy fingers sabotaged our profitable trades? By planning the trade and letting the computer program carry it out, we significantly increase our odds of staying committed to the trade plan. The only two disadvantages that I have encountered from using an OCO order are: number 1, having your order partially failed, and number 2, losses from black swan events. Having number 2 at a bad timing can seriously turn into a shitstorm. This is why understanding position sizing is essential. If you invest too much in a single trade, a single bad loss can shake you out of the market. If you want to learn more about position sizing, then check out the other videos on this channel. There are links in the description below. Tip number 3. Set trading stop losses to save time. This tip is useful for managing trades that have already gone into profits and takes up no more than 5 minutes to carry it out. One of the worst feelings in trading is watching your profits get decimated in a blink of an eye. This is where trading stop losses come into play. A trading stop loss allows you to lock in a certain percentage of profits and protects you from sudden market reversals. This is particularly useful if you are serious about trading but hold a full-time job. It is impossible to have your eyes on the screen 24/7. And even if it is possible, too much screen time can be counterproductive as it creates a compulsion to overtrade. With a trading stop loss, you can focus on your work while having a peace of mind. Now let's look at how a trading stop loss is applied. This is the ROSE/BTC chart on the 1 hourly. So let's say, hypothetically speaking, we entered the market over here. We managed to catch the retest of the mean of, we managed to catch the retest at the mean of the Bollinger Band, which is also the EMA 25 and 7. So let's say we managed to enter over here. And then we rode the market all the way up. Now at this point in time, I would like to close, or I would like to secure some profits, simply because it does not make sense for me to accumulate all these gains, all these profits, only to give it all back. So let's say if the market breaks below the mean of the Bollinger Band, EMA 7 and 25, we will consider it as turning bearish. So with that narrative in mind, we will set our trading stop loss at 240 over here. So if this bearish signal turns true, and if price trades below this consolidation area, we would close our position and take whatever profits that's left on the table. And I think that makes prudent sense. Imagine if you have gotten all these profits, the market has advanced and made all these gains, and let's see if we would have successfully entered over there, we could have made a maximum of perhaps 44%. So realistically speaking, perhaps you catch 40%. So does it make sense to give back all these profits? Does it make sense to give back 40% profits in the hopes that you'll gain more, with the risk of trading this into a loss? I think not. So if you have set a trading stop loss, at the very least, you would have taken 18% off the table. While it's not spectacular, while you did not capture the full move, at the very least, you're not in a better position to take on your next trade. And if you look at this market, it did went down. And if we continue hodling this position, we would have traded a profitable position into a loss. I think that makes very little sense. And this is where trading stop loss comes in. It is very powerful in protecting your capital and protecting some of your profits. Different exchanges have different stop loss functions. The previous example used a trading stop loss that must be manually adjusted. This exchange allows you to set a trading stop loss as a percentage above or below the current market price. So look around the internet for exchanges that provide the functions that complement your trading styles and needs. There are many factors to consider when choosing an exchange. It is not as simple as comparing trading fees and commissions. If you want to learn more about how to choose an exchange, there's a link to it here and in the description below. The important thing to take note of when setting a trading stop loss is to avoid placing it too close to the current traded price. Prices in the market do not move in a straight line. It swings up and down towards a certain direction. If you set the trading stop loss too tight, you might get shaken out of the market while the trend is still in progress. It is vital to give the trade some freedom to breathe, to allow it to oscillate naturally as the forces of supply and demand finds balance within the market. So how much breathing room should we give the trade? And how close should we set the trading stop loss? This is the subjective part of trading. Generally speaking, you want to look at the standard deviation of the market. Historically, if the market moves at around 5% per day, then it would be too conservative, in my opinion, to set a trading stop loss less than 5% from the current traded price. Because if the market oscillates naturally at 5% per day, then it would make sense to give the trade a 5% breathing room, allowing it to accommodate for the noise within the market. Personally, I review my trades every morning. Trading stop losses are adjusted while I'm having breakfast or on my commute to work. This is how I manage to trade multiple positions while working a full-time job. The key is to develop a routine. Tip number 4, set strategic price alerts. As mentioned earlier, there is no way you're going to monitor the trades every 15 minutes while you're working a full-time job. You need to let technology do the work for you so that trading becomes as effortless as possible. You have to make the market work for you, not the other way around. Or anyone can set up price alerts. Intelligent traders will place price alerts where action is actually needed. Imagine if you have two price targets in mind. Let's say we plan to buy at a support and sell at the resistance. And if no action is to be taken while price is swinging within these two boundaries, why waste energy staring at the charts? Price alerts are especially useful in keeping the trader disciplined in planning the trade and trading the plan, because you would have planned for the conditions needed before entering the trade. But I have to admit, there are times when the computer glitches out, so it is still a good idea to check the charts periodically. I have a video where I talk about how often I check my trades, so do check that video out if you want to be more productive in your trading. The final tip: make friends at your workplace. Unless you work in an office full of snakes, most colleagues will be supportive or at the very least accommodate your financial needs. Even better, introduce them to the world of trading and this channel. Nothing makes work more fun than having co-workers with shared interests. I have actually learned from colleagues who were traders themselves, but we wouldn't have connected if I did not share my trading passions. But of course, if a job is very strict, full of snakes, doesn't allow devices, then ignore this tip. But keep studying technical analysis and get better at trading so that you can one day liberate yourself from this sneaky environment. Now let's go through a summary on how to juggle trading with a full-time job. Number 1, trade longer time frames. Number 2, use OCO orders. Number 3, set trading stop losses. Number 4, set strategic price alerts. And number 5, be friends with your colleagues. If you want to learn more about trading, then subscribe to this channel to get the latest insights. All the best to your trading, and may all our trades go to the moon. I'll see you guys in the next video.